In this set of videos, we're going to talk about working capital management. This is really a very important part of managing a company, right? Without working capital management, the company cannot structure or cannot function. So working capital management consists of current assets and current liabilities. How do you control those? How do you manage the process? So current assets are referred to as gross working capital. Cash, marketable securities, accounts receivable, and inventory. Now, accounts receivable and inventory are not cash per se, but they should be cash relatively quickly, since accounts receivable, the debts that people owe us, they will pay, hopefully as quickly as possible. And of course, inventory is turned into product and ultimately is sold. So net working capital is the difference between current assets and current liabilities. And of course, management of that talks about how effectively and efficiently we control that process. So what are, again, the primary assets that we're talking about? Managing cash, marketable securities, accounts receivable, and inventory management. We've looked at different ratios with respect to these. So we have an understanding. If you look at the company's financial statements, you have an idea of how well they are managing the assets. The question that we're talking about here is, how can we develop techniques or tools to improve upon our current management of those assets? So the goal of cash management is to try to get the highest possible return that we can on cash. Now, cash by itself doesn't earn any return. So we have petty cash, cash on hand, and cash in the bank, like in a checking account. Typically, especially for a person, these things don't earn any return. However, sometimes checking can earn a bit of a return. Savings can earn a bit of return. But again, the idea here is to get the highest possible return. We're really not necessarily looking at the return on cash per se, but based on the amount of cash that we have, how can we generate a higher return for the company? As we need to find ways to minimize the amount of cash we actually have in hand. We want money to be working for us, not sitting somewhere idle. There was a video here that talks a little bit about what a CFO does. And I think it's interesting video to kind of think about exactly what the manager of cash does. That is, this CFO of the company, the chief financial officer. So again, we want to manage cash flow. Essentially, the technique is very simple. We want to speed up the collection of money, and we want to slow down the disbursement of money. Excuse me. So disbursement float is the time that elapses from when we make a check payment to when the check actually clears the bank. There is a time frame. So if you write a check and mail it, as soon as you mail it, the clock starts to tick. That money is still in your account. By the time it gets to the company that you wrote the check to, it is still in your account. It is not until the company deposits it in their checking account and the bank actually withdraws it from your account, that is disbursement float. Collections float is the amount of time that elapses between when a check is deposited in your account and the check actually clears, right? So there's two ways of looking how this ultimately works. The disbursement float works from the perspective of the person that is writing the check, and collections float is looking at the perspective from the person that's receiving the check. A couple of ways we could do this, and these are two very, very simple ways really, is something called a lockbox. It's a post office box that essentially an agent of the bank goes and pulls out the checks every day, and those checks are ultimately automatically invested or placed in the checking account of the company. So essentially what happens is we've kind of taken out of the mechanism, you will, the time that the check is at the company. So somebody from the bank opens the post office box, takes out the checks, and automatically deposits them. That information is then transferred to the company so they can post it to your account. Electronic funds transfer is, again, is a way a lot of people currently do online banking. Essentially, you just transfer funds from one bank account to another via the computer. Again, the idea there is nothing in the mail. There's no mail time, right? There's no company time. It automatically goes from point A to point B without delay. Marketable securities are typically very short-term securities, right? Normally we're talking about United States Treasury bills and maybe some government bonds. Your textbook talks about corporate bonds and stocks. These are not typically thought of as being marketable securities. So as far as a definition here, anything that could possibly be turned into cash within the next 360 days, or anything that you would think that you would be converting into cash with respect to things like government and corporate bonds and stocks. If you have a set of, as part of your strategy, in the next 60 days, you're going to sell some stocks. Those stocks can be considered marketable securities, not because of the length of the security itself, but with your individual investment horizon. So you sort of have taken this thing that typically is long term, and you're addressing it as currently a short-term asset. So excess cash then, whatever we have left over from our cash management strategies, should always be invested in some form of marketable security so that it can earn a higher rate of return. The challenge is, how much is excess cash? How much do you need to have to run the business, and how much should be set aside? If we think about accounts receivable, I mean, really, what is an accounts receivable? An accounts receivable is an interest-free loan that's provided to our customers. They take some of our assets, they purchase something, but they don't pay it today. They're going to pay it sometime in the future, typically a very short time frame. So how do we go about this? What options are there? How do we manage, if you will, this accounts receivable? So we can just wait for the money to come, right? We can issue credit and wait for that money to come back to us. We could, a couple other options, we could do something called, or issue a credit card or a line of credit, so that there are some mechanisms in place for the gathering of this money, but also to possibly gather some interest on the purchase from the customer. Again, remember, an accounts receivable in its truest form is an interest-free loan. Factoring is a process where we could actually sell our accounts receivable to another company. So we would say, hey, look, I have $100,000 worth of accounts receivable. I would like to sell those accounts receivable to you. And I'll sell them to you if you give me 90,000, I'll give you the right to receive 100,000. So they get a discount, and then the money that's received, the 90,000 goes right to the company. But as the $100,000 is paid to the company, we will then ultimately pay off this factor to the business that lent us this money. And again, there is a video that talks about factoring in a little bit more detail. But if you think about customers, right, who are we going to give an interest-free loan to, right? We need to manage our accounts receivable. In the business world, there is something referred to as the 5 C's of credit. What is a customer's character, right? Obviously, we want to look, has this customer paid their bills on time in the past? Do they have favorable credit references, right? So maybe we'll be looking at FICO score for their character. Capacity, are they able to pay? Do they make enough money? Do they have enough cash flow to be able to pay back the loan? Capital, what is the assets or the applicant's net worth? How much collateral do they need? Or do we want to offer them a loan but require collateral? Is there something there that we can use? And of course, in the end, the general conditions of the economy are important. So, except, borrowers that have high values in real estate with the market that was declining fairly rapidly just 5 or 6 years ago, right? They may be considered too risky, right? So maybe based on their condition, their assets, their collateral, etc., maybe those types of customers may not be offered the same credit arrangements that a more financially secure person, again, based on the 5 C's, on them. Credit terms are things that we can offer the client or the customer to encourage them to pay us a little quicker, right? So to speed up collections, we might offer something called a cash discount. So in this case, they give us an example of 210 net 30. So if the customer pays their bills in 10 days, they'll get a 2% discount on this invoice. If they don't pay in 10 days, the entire amount is due 20 days later. So essentially what this does is it reduces the cost of your inventory if you pay within 10 days. Now, what if you don't pay within 10 days? Obviously, if you don't pay within 10 days, there is a cost. Now, it's not a true cost, right? Because you had to pay the value of the inventory, but it is an opportunity cost. And in this case, the cost can be severe. It can be rather high because you're going to buy inventory over and over and over again throughout the year. So if you want to analyze accounts receivable, there are 2 things that we've talked about in a previous video. Something called accounts receivable turnover, which is just the credit sales divided by the average accounts receivable. So in this case, 6 times per year they turn over their inventory. Now, if you divide that into 365 days, essentially this our payback, our collection period is 61 days. So on average, it takes a client 61 days to pay us back. Well, that seems like a relatively long period of time to me. We would like it to be closer to 30 days. In fact, what if we had offered a cash discount? What if we offered them the 210 net 30? We would expect the collection period, these collection days, to be much closer to 10 than certainly to this 61 days. So again, if for some reason this collection period is too high, we need to figure out a way to manage this, right? If they exceed our terms, we have to figure out how to get clients to pay us quicker, right? So one of the things that many companies don't do that they should do is companies should have a written collection policy. The reason for this really is to follow the guidelines of the Fair Credit Act enacted by the legislature of the United States government, right? Everybody needs to be treated fairly. When we say fairly, everybody needs to be treated the same. So if you have a written collection policy, it might say something like, hey, we're going to send you a letter to remind you to pay. And then maybe we'll send you another letter to remind you to pay. And I'm sure you may have gotten these from time to time, right? The company sends you a letter and says, hey, I think you might have forgot to pay this bill. Now, if you've paid it, don't worry. This is just a reminder. So if our bills have passed in the mail, there's no problem. But if you haven't paid, this is a reminder. And then second, we want to send them to collections, right? Figure out a way to get them. Maybe we have to, again, sell this account to somebody else. Obviously, we have to pay them for the collections. But our need is we need cash. Again, a final question might be, do we want to stop selling to these people if they can't pay us in a reasonable time? And the answer is, I'm not sure. Depends on the economic conditions. It depends on the relationship that you have with this particular customer. Sometimes we need to make arrangements. So maybe instead of offering them accounts receivable, maybe we offer them some type of a trade arrangement where we're going to charge them interest. So instead of an accounts receivable, maybe we offer them a notes receivable. This notes receivable would apply an interest to their purchase. So one of the ways we can kind of look at this management is through what's referred to as something as the aging of accounts receivable, right? We want to figure out, right? Look at our accounts. Who owes us money? What is the average time that these certain groups are taking to make payment on their accounts? So to earn this, here we have 10 customers. Here are their days outstanding. And what we do is we identify the amount of money that's owed to us between 0 and 30 days, 31 to 61, etc. And we look at these percentages. And you can see that about 16% of our clients owe us money for longer than 90 days. These are the people that we're really worried about, right? They owe us money for a very long time frame. It's unlikely that we'll actually receive these funds, or we need to encourage them. Maybe we need to talk with them about their payments, see what the issues are. 61 to 90 days. These customers are still in danger of not paying us. And if you add that up, that's 45% of our money is owed longer than 60 days. That could be a very big problem when we're trying to speed up the receipt of the money. Again, remember, an accounts receivable is an interest-free loan. So if we're lending interest-free, that means they have our money and we're not earning anything on that money. We need that money. We need to buy inventory. We need to invest the extra money in maybe marketable securities, etc. So that's the end of the first part of the working capital management video.